Hey folks, welcome to Pro Trader Strategies. It's Thursday, August the 19th, and we are doing Spotting the Trade. So before you go though, make sure you hit that subscribe button over there. There's also a little bell that'll give you a notification if I come on unannounced, so make sure that that's clicked as well. Also smash the like button, it helps us out. And finally, throughout this video, comment over at the side or down at the bottom there, and let's go back and forth. I want to know what you guys are looking at, and let me know if my trades are a little bit bizarre to you, and we'll go back and forth, and I'll try and explain it a little bit further in detail if I haven't so far. All right, so without further ado, let's get on with the economic data and see what's going on in the markets. Here in the United States, we got the Philly Fed manufacturing. Now, I've been talking about these manufacturing numbers, Chicago PMI. Well, this is in line with that manufacturing index, and it came in at 19.4. Expected to be 23.2. So again, seeing the manufacturing sector slowing down here a little bit. Now remember, just yesterday we got the crude oil inventories. Inventories for distillates, which goes into the manufacturing process, was actually a drawdown. We saw a build in gasoline as we're seeing people travel a little bit less here. And that is looking like something that we're going to see going forward here. We're starting to see a bit of a slowdown in the overall economy. We're still seeing inflation creep up, folks. So are we going to have a situation where the economy is not moving, but we have inflation rising? That's not a scenario that the Fed wants to get involved in. And we don't want that kind of economy because when you have inflation moving higher, the reason why we want that to happen is because we are, as consumers, driving that. Now, if we see a slowdown in the economy and inflation driving higher, that isn't due to us having demand for that. That is a bad situation. That's called stagflation, folks. Not quite there yet, but something to keep your eyes on the ball there on something like that. With rising inflation and we see a stagnant economy, that not good. All right. Unemployment claims lower than expected at 350,000. So there is the one thing that really kind of was a shining light there. And we got the LEI, leading economic indicator. Now that came in a little bit better than expected at 0.9%, expected to be 0.7. Now, something to note with that number though, we are seeing that number drive a little bit higher, but it is a bit of a surprise. This is a culmination of several other economic data points that we've seen before. And we've been seeing weakness here. It shows up in the LEI as a bit of strength. That seems a little bit out of focus for me right now. They did revise last month's number down, albeit slightly, but I think that we might actually see this number get revised down because we're seeing these numbers that go into this index a little bit weaker than what I would have expected here to see on this. All right, so let's get on with the overall markets and see what's going on there. We've got crude oil coming off a little bit here. Let me move my share screen thing to indicate. We got crude oil moving lower today. Now, I talked about that 65 number yesterday. We were just slightly above that. We're breaking back down into the value area and in and around this volume node that I've been talking about so much. I thought we would revisit this location a little bit sooner, build in some of this volume in and around that. That would be acceptance of value. When you get a point of control that is really far down, shift higher, acceptance of value at higher levels is bullish. But having said that, we aren't seeing the strength for crude oil, whether it's in gasoline or distillates that go into the manufacturing process. I think that's going to be a little bit weaker, so that we're going to see some downward pressure, but I think we will at least stay in the 60s for the foreseeable future. I think we're going to get a bounce off of this Fibonacci here and maybe start trading in and around mid to lower 60s here. And then we move over to the other dollar denominated assets. Gold futures are off of their lows. We're seeing a broader market rally here today. That is going to be something we're going to keep an eye on, especially at the end of the day here, because a strength at the end of the day is going to make it look like we found a little bit of a bottom. We'll talk about the equities here in a little bbit, but we're seeing a lot of them bounce off some major support areas that we'll talk about here to keep an eye on. Bitcoin's moving a little bit higher here. As you know, people are going back to accepting cryptocurrency. Another big thing that we saw come out today was HOOD, H-O-O-D, is Robinhood's ticker symbol. Something to note about Robinhood, we've talked about this in the past, that people that are on Robinhood seek volatility. Remember with all the meme stocks, they were going after those gangbusters because there was a lot of volatility in there. Now we've seen things like GameStop and some of these names that they were trading earlier really settled down, volumes coming out of that. Well, these folks are seeking volatility. Where do you find it? Cryptocurrency. So something to note with their earnings on Robinhood. This is giving us a real good insight at these newer traders. Remember, this generation right now is the youngest generation to start investing, but they are seeking volatility. That said, they're moving over to the cryptocurrency. Over 50% of Robinhood, I'll just go over to their chart right now just because I'm talking so much about Robinhood and cryptocurrencies. But Robinhood seeing some weakness here because they're seeing some volumes slow, and that is more so in the equities. Now, remember the payment for order flow? I don't know if that necessarily translates over to the cryptocurrency, so they could be making money off of the cryptocurrencies transaction. I don't know that much about their business structure, but the switch over to cryptocurrency seems like where they are generating most of their capital. As a matter of fact, over 50% of their capital or their revenues were generated from people switching over to cryptocurrency. Now, of that, if you think about half of their bucket of their income is from these cryptocurrencies, well, think about this even further. I've talked about the stronger cryptocurrencies like Bitcoin, Ether. These folks are trading Dogecoin. 62% of their crypto volume is in Dogecoin. That is it. As far as I'm concerned, folks, an NFT, a non-fungible token, it doesn't really have value other than, the pet rock is what I kind of compare it to. My day and age, somebody used to make rocks and put faces on them and people were buying those silly things. Well, that's kind of similar to what we're seeing here with the non-fungible tokens, especially in Dogecoin, which was created as a joke. And these folks are trading it back and forth. That seems like something that could be very difficult to manage, especially in Dogecoin, where there really isn't a finite value to that. That could really cause some angst. All right, bonds are moving higher despite the fact that every Fed governor talking about easing and the quantitative easing, all of the asset purchase slowdown, all of that noise seems to be thrown out the window, folks, because we're seeing the economy start to slow. We would think that the Fed would be on top of that, but it seems like they're behind the ball right now. I think the Fed is going to have to hold on at least until next year, 2022, folks, on that tapering of the asset purchases. I don't think that they're going to actually, they might even talk about it, but it's just not going to happen. The only reason why they would talk about it is to get everybody off their back. All right. We were seeing a massive spike in the VIX. That was as the equities were free falling this morning off pretty crummy economic data across the pond. And here in the United States, we've been seeing economic data come in a little bit lackluster. Now, why are the equities moving higher? Well, because it's a signal that the Fed is probably not going to stop this taper or start a taper to create a tantrum. And they're going to continue their asset purchases. We even talked about if they do come back and say we are going to slow the asset purchases, it's only a drop in the bucket that would not be an indication that interest rates are really on the rise there. But NASDAQ, near the highs of the day, we all in the equities came down and tested the 50-day simple moving average. At this point, we are above that. Now, remember, I've talked about this time and time again. Below the 50-day simple moving average is going to start signaling some near-term weakness here. 9-day is like a couple of days weakness. 50-day is, a couple of weeks. You get below the 200-day, and we are starting to signal a very longer duration bearish turn. We're not quite there yet. We're testing this 50-day several times in the E-mini S&Ps and have now started moving higher. This is the Dow Jones, sorry. And you can see we've tested that 50-day simple moving average. It's settled below there a couple of times, but rebounded. That's something that we're going to be keeping an eye on today. Very good setup for a bullish move here. We get this kind of a hangman doji at the bottom of this type of move, especially testing something like this 50-day simple moving average. It's looking a little bit more bullish now. I've been talking about risk being to the downside. Going into next week, we're going to have to be looking at risk to the upside. Not because the economy is doing so well, folks. It's really because we're going to be looking at the Fed's easy monetary policy, giving us a bit of a boost to the upside in equities. E-mini S&Ps, again, near the highs of the day, into positive territory. Wasn't really expecting this, especially this morning off the open, testing this 50-day simple moving average. But again, E-mini S&P is another great representation of following this 50-day simple moving average. Well, what would I say? Well, if it comes down to test that 50-day simple moving average, it seems like a element for good strike location. All right, we can see here on the economic news, we got a bit of a rally here. I've been throwing a wet blanket on this. Why? Because we're talking about stagflation, all of these bad things in the economy. Well, the market's seeing the same thing, but they're also digesting what we just heard from the Fed. And that is something where we think they're going to be backtracking on some of those statements here going forward. All right, let's get on to the trades. All right, JP Morgan, folks. I am out of this trade. If you guys remember, I got in on the November, bought the November 155 puts in there for, what was it, $5.80, I think. So I paid $5.80 on the November 55 puts. Sorry, folks. A bit of a frog in my throat or something. So on these November 55 puts in JP Morgan, I played this on the 13th, so about 5 days ago when we got this topping pattern. We had low volatility during that line. You can see we got the low volatility. What happens when we have low volatility and a bearish assumption? Well, we think that we need to limit that theta decay. That means we go further out in time, right? Well, we also need to take advantage of some volatility expansion. If we have that low volatility, that leads us to buying options. So in that case, I have a bearish assumption, low volatility. I want to go further out in time just to limit that theta decay. That's why I picked those November, bought the 155 puts in there for $5.80. I got out of them this morning for $7.40. Or sorry, I got out of these yesterday's, folks. You can get out of these a lot better today. I got out of these yesterday on that bounce. So this was right before the closes. The market was selling off. I was able to get out of those. Sorry, I got into those for a $5.80 credit. I don't know what I was thinking there. I'm getting a little brain dead because the volatility was low. We got that expansion in volatility in the directional move yesterday on the sell-off. I got out for a $7.40 credit. So bought them for $5.80. Sorry about that. Got out for $7.40. Volatility helping me, directional move helping me right back down to that point of control today. Hopefully you folks stayed in this a little bit longer than me. I had that working order yesterday. I think the high right after somebody hit my 740 offer and lifted the 750 offer almost immediately. They ripped right through us on this JP Morgan trade. Now, the other trade that I did, I added to Las Vegas Sands. Remember, if you guys have on the September 35 puts in there that I originally sold for 40 cents. That was right when it was around a 16 delta. Well, we've sold off since then. And, you know, some people are saying, hey, you shouldn't throw good money at bad money being add to this trade. Folks, if I flip over to this Las Vegas Sands, we are at the lows, basically, of where we saw the pandemic. Now, I've talked about this with Caesars, right? We got Caesars here. We talked about them through the pandemic. They've seen their occupancy drop by over 50%, but they are seeing record revenue or record profits because they streamlined everything. So they've gotten rid of a lot of the fat. I think that not only Caesars, but across the board, some of these other folks that are in the casino sector are doing the same thing. So while we're seeing Hyatt and the other hotel chains do worse and actually seeing their occupancy really fall out of bed, I don't think that's necessarily going to cross-translate to Vegas, because Vegas is one of those destination places where people will go. And we've seen the occupancy at Vegas be at about 50%, and these profits go through the roof because they're streamlining the process. I think Las Vegas Sands and the rest of them are doing this similar streamlining of the process. So at this level, I am absolutely willing to get long Las Vegas Sands, which is why I'm adding to this trade. And with that said, I went into the SEP, sold those same 35 puts for 90 cents. Now, the market has sold off a little bit since then. But again, I'm willing to get long Las Vegas Sands at 35. That is very near that real low that we saw during the pandemic. I don't think that we are seeing that kind of issues going forward for at least the Vegas casinos, folks. I'm not talking about Hyatts and the Marriott's and all of those. Those guys, those folks might struggle, but I think the Vegas might do very well here. So I'm willing to add some to this trade with that volatility expanding. I'm going to take advantage of that. So added to the 35 puts that I'm already short today by selling those 35 puts for 90 cents. And Pfizer, I don't know why Pfizer, please comment over at the side because I really don't know why Pfizer's volatility is blasting off here unless it has something to do with a trial or something. We're seeing volatility continue to expand after these earnings. So comment, let me know if I'm off my rocker on this trade going in with too much risk in Pfizer because I decided to go in there in the SEP, sell the 44 puts for 40 cents in there. Again, 44 puts. Down here where this high is, very close to that. So that is going to act as support. As we come back down there, I could probably throw some Fibonacci's up there for you folks and see what happens there. Or maybe not. Let's just try and do it dirty. Are you going to give me a Fibonacci? I can see it's lined up there. Let's just throw a Fibonacci up there. That's quick and dirty. So you can see there's a couple of areas of support. One of those is right around that 44.50 area. This is quick and dirty, but I can say that 44 is absolutely going to be a support here in Pfizer. That's perfect strike location for where I am selling my puts. Slightly below that with a credit that I'm getting, it's also lowering my overall break even on this trade below 44. So 44.60 or sorry, 43.60 is my break even because I bought or sold the 44 puts, got a collection of credit at 40 cents. That lowers my overall cost basis by that 44 cents. So 43.60 is my break even, a full dollar below our 61 Fibonacci here. So I'm going to play that one out as well. And I think that's about it for my charts. I think I wanted to look at talk about a couple of other things. Toyota Motors finally coming out. They're in the same camp now, folks, as Ford and the American car companies for the most part. Ford being one of the big ones. Something with Ford, folks, they are going to stop production at one of their plants because they can't get these chips. Now, Toyota Motor, after I don't know, after the reactor blew up there, I can't think of Fukushima, I think. Anyway, basically their government came out and said, folks, you aren't going to do just-in-time manufacturing anymore. That means when you have it, the delivery comes in and you're going to have to carry inventory of these. That's why Toyota actually did fared pretty well through this whole chip shortage thing. Well, that inventory is gone, all right? And they are talking about closing down one of their plants in Nashville, I believe, and a 40% reduction of a plant in China because they are out of these coveted chips. Again, Ford, some people can get the cheaper chips, but some of these other manufacturers like Ford and Toyota are looking for some of these best-in-class chips, which is why they're not really being able to get a hold of those. Some of these other manufacturers are able to produce cars, but they're not looking for the same chips, okay? So Ford, Toyota getting dinged today based on the fact that they're out of chips too, and they're going to have to start closing plants as well as Ford. And I think that's about it. All I wanted to talk about there. Nvidia, good thing I got out of those, right? Yesterday on my shorts. Well, today, blasting off to the upside. They are talking about net profits going through the roof by three times, all of that stuff having to do with demand for chips and everything else. So good thing I got out of those yesterday ahead of earnings. I would never suggest anybody go into earnings necessarily with a directional trade based on a technical setup, okay, which is exactly what we did here with Nvidia. And I've had that on for a while, and pull those off before you, especially on a technical setup, because anything can happen on the earnings. Now, if you're playing the earnings specifically for the earnings on a directional move, I have no problem with that because you've gotten involved at a point where volatility is coming out and things like that. in a situation where you're just looking at a bearish move coming into earnings, that just doesn't seem as good of a trade in my eyes. It's just kind of a dice roll at that point. All right, especially on synthetic longs and synthetic shorts here. All right, so Nvidia is another one that I got out of. That's about it for everything. Open Table, something to note with bookings at Open Table. We're talking about the reopening trade. Open Table is where you kind of book a reservation at a restaurant, down 10% almost from their growth forecasts, or down, inflation up. All of those things is what they are noting. So that is something we are going to have to note. Even people going out to dinner, all right, slowing growth. People are staying at home a little bit more. A couple of other ready to travel folks saying that they're ready to travel. It's below 50%. Now, is that due to the kids going back to school? It's August. Folks are going back to school. So why would I think I'm going to be going on a vacation right now or traveling because the kids are going back to school? I can't take them. So is that part of it? And we're going to have to keep an eye on that. But the hotels, a little bit iffy. If you're looking at something for travel and leisure, I would lean towards a little bit towards that Vegas and that destination type place. Not necessarily Disney. All right. That's it, folks. I think I've wrapped it up pretty much. You guys check it out today. This afternoon, we're going to be talking about trades that we can implement when we don't really know what direction this underlying is going to go, but we think it's going to either pop or drop. That's going to be happening here on our upcoming webinars. Today, we're going to be talking about how you implement a put butterfly. I'm going to talk about the nuances of a butterfly. They don't always follow regular rules that we talk about for trading options. So make sure you check that out, because just like the butterfly in real life, it morphs. And this is a bit of a morphing of what we normally look at for our strategies. All right. So before you go, make sure you click on that subscribe button, the little bell, in case I pop on later on in the day. Probably not going to do it today because I got that webinar. I'll be popping on later after the close, though, for that. And smash the like button for us. It helps us out. And if you have any comments, questions, or anything you guys want me to cover, let me know if I'm off my rocker. Throw it over there in the comments section. Let me know if I'm fine, if I'm doing something wrong in this. Does Pfizer have a trial I don't know about? Am I stepping in something I didn't see? Let me know over there in the comments section. I'd love to hear from you folks. All right. So that's it. Other than the last is, if you can't take that, take it easy. Bye for now.